This is Professor Melanie Hildebrandt. In this video, I'm going to work an example related to Chapter 7 on global markets. I'm calling this Part 1 because I'm going to post a second video that also shows the effect that tariffs have. But in this example, we're just going to look at the impact of trade on a domestic market. So let's get started here. All right, so suppose this is the market for steel in India. So the domestic market here that I'll be referring to is the market in India. And if India was a closed economy, meaning that they do not trade with others, then the price of steel in India would be $60 per ton, and the market equilibrium, we'll just say it's 100 tons per week. Okay, so again, no trade with anyone else, then this is equilibrium in a closed economy in India. But while we have this graph here going on for the market for steel in India, there's the larger market for steel, the world market. And so suppose in the world market that the price for steel, so PW stands for the price in the world market, so the equilibrium price there is actually $100. So I want to see how this then impacts the market for steel in India. Well, what it's going to do is it's going to raise the price of steel in this domestic market in India to $100. Because steel firms that operate in India are able to sell their steel in the world market for $100 a ton, it means that consumers in India are also going to have to pay $100 per ton. Let's take a look here at what happens to quantity supplied and quantity demanded in the domestic market. They're no longer in balance. They're no longer in equilibrium. At this higher price, firms might be willing and able to pay for 150 tons, willing and able to produce 150 tons per week, but our consumers only want to purchase 90 tons per week. So here we have excess quantity supplied or a surplus. And so what we see when we have free trade, okay, so our economies are not closed and we're allowed to trade with one another. When we have free trade, if there's a surplus present, then India is going to export this steel. And so the surplus of 60 tons per week would become exports out of India and to the rest of the world. When we have this situation where the world price is higher than the equilibrium price in the market, it means that that country has the comparative advantage. Okay, so in this case, the firms in India have the comparative advantage in producing steel, and therefore they become exporters of steel to the world market.